Okay, we're going to continue talking about money. So we went over currencies and paper money, checks, personal checks, cash coins, any way that we pay for things, debit cards. So we're going to talk a little bit about the money supply. So we're going to get into a little of economics, supply and demand. Okay, so the money supply, when we refer to the money supply, that's the total amount of money or assets that's available in the country's economy. So that's how much money is out there, whether it be in checking accounts, savings accounts, but it's all the cash, coins, and balances that are held in checking and savings accounts. So the government keeps up with what the money supply is. All the money is their serial numbers on the money, so they can determine how much money is out in the economy at any given time. So the money supply can impact the price level, inflation, and the business cycle. You know, inflation is when prices go way up, and it all has to do with the supply of money that's in the economy at any given time. So money demand is the opposite. It's the desired holding of financial assets in the form of money, cash, and bank deposits. So the money demand is affected by many factors, including the level of income, because the more money we make, the more money we have to spend. Interest rates, if interest rates are low, then it allows more people to go out and borrow money because they can afford to. When the interest rates are really high, then it cuts a lot of people out from being able to borrow money because they can't afford the payments. So interest rates and inflation, if prices are really high, people aren't spending, they're not buying as many things. When prices are low, then they're spending more money. Okay, we're going to get into the next unit, which is money and the banking history. So this is a little bit about the evolution of money in the United States throughout the years. So the United States has changed the way they issue money and the way that money is used throughout the years. In the early days of this nation, before and just after the American Revolutions, Americans used British, Spanish, and French currencies because we're a new nation compared to England and some of the nations in Europe. So right after the American Revolution, we didn't have the dollar. So they used British, Spanish, and French currencies rather than the dollar because it wasn't a thing then. So in 1775, in order to finance the Revolutionary War, because war costs money, the Continental Congress issued the new nation's first paper currency known as Continentals. So it was a paper currency, it was known as Continentals. However, because the currency notes were issued in large quantity, so they weren't as savvy now about supply and demand, so they issued too much of it. It led to inflation. So it led to the prices going up because there was too much money out, too much of the Continentals, which was used as money. The phrase "not worth a continental" came to mean utterly worthless. You don't hear that phrase that much anymore, but I have heard it, not worth a continental. So that money wasn't really worth anything. So then in 1791, Congress established the first bank of the United States, 1791. It was headquartered in Philadelphia in order to further support the Revolutionary War. So there were a lot of people at that time, they weren't comfortable with the idea of a powerful central bank. So they didn't trust the bank that much. So by 1811, when the bank's 20-year charter expired, Congress refused to renew it. So then in 1816, Congress agreed to charter the second bank of the United States. So they're going to try again. Several years later, they're going to try again. This attempt also failed. When it was the second bank's charter expired in 1836, it was not renewed. So they were trying to have a central bank, but the people just didn't trust it, and so eventually failed. So then, after the bank charter expired, the second bank charter expired from 1836 to 1865, was known as the nation's free banking era. So what happened during this time is states started opening banks. State chartered banks and unchartered free banks took hold during this period, issuing their own notes. So basically, a state would open up a bank, and maybe even somebody that didn't get a charter. And to get a you have to get a charter to open a bank. You have to go through a lot of different, government regulations in order to open a bank. So some people were opening banks without even getting chartered. So what happened is that they just issued their own kind of notes. So there was all these different types of currency out there. So by 1860, more than 10,000 different banknotes circulated throughout the country. So it was mass confusion because one bank had their own type currency money, another bank in that state had a different kind. So 10,000 different kinds of currency. So there wasn't hardly any regulation of banks at that time. So banknotes were easily counterfeited because there wasn't much regulation. So many of these banks failed, and there was a lot of confusion, circulation problems. It was just mass confusion during this time period, known as the free banking era. So then in 1863, during this time, Congress passed the National Currency Act. So the next year, 1864, President Lincoln signed a revision of that law, the National Bank Act. So these laws established a new system of national banks and a new government agency headed by a comptroller of the currency, whose job was to organize and supervise the new banking system. And there still is a comptroller of the currency, and they do some of those same duties that they did when this law was enacted by President Lincoln, the National Bank Act. So a little bit more regulation going on. The national banknotes were produced and distributed by national banks chartered by the U.S. government. So national banknotes. So they had to be a national bank. So there are some state chartered banks, there's some national banks. There are still some state chartered banks, but there's more national banks that are chartered by the U.S. government. National banknotes were the mainstay of the nation's money supply until Federal Reserve notes appeared in 1914. So from 1863 to 1914, our money was national banknotes that was issued by national banks. In 1879, the U.S. adopted a gold standard. In such a system, a standard mass of gold defines the value of a currency unit. So, for instance, if the United States sets the price of gold at $500 an ounce, the value of a dollar bill would be 1/500th of an ounce of gold. Okay, so the gold standard. So, this was a currency unit. Could be used as a means of exchange. In 1900, Congress passes the Gold Standard Act. This made the gold dollar the official standard unit of currency. Gold was the official standard of currency. The value of every dollar of paper money or coin was equal to the value of a gold dollar. It says in 1900 it was equal to the value of 23.22 grains of pure gold coined in money. Okay, then we're getting more progressive. In 1913, the Federal Reserve Act was passed in response to the 1893 and 1907 financial panics. And we know about the Great Depression that happened in the 20s, but these two were very significant also. Federal Reserve notes are authorized by the Federal Reserve Act and are the legal tender of the United States of America. So we still have the Federal Reserve Bank. It was founded to provide the nation with a safe, flexible, and stable monetary and financial system. So the Federal Reserve Bank is the overseer of our money supply, and they make monetary policy that affects the economy. And there are 12 Federal Reserve Banks. One of them is in Dallas, and we'll learn where the other ones are. But the one in Dallas has a region that they make, that they oversee the banks in that region and supply money for them. And so the Federal Reserve Bank is the current central bank of the United States. Sometimes we call it the Fed. It has 12 regional locations: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. And last year we went to the Federal Reserve Bank in Dallas. We went on a tour. That's where the Federal Reserve Bank makes policies for the region that they're in charge of. And it's not just Dallas. It's and there'll be a map here in a minute that'll show you where they're in charge of. But they provide money to all the banks in their region. There's a Fort Worth Mint that we went to one year that actually makes money, that prints money, and they provide it to the Federal Reserve Bank, and the Federal Reserve Bank provides it to the banks. The Federal Reserve Bank is considered to be independent because its decisions do not have to be ratified by the President or any other government official. So the Federal Reserve Bank has a lot of power. They're in charge of a lot that has to do with our economy. However, it is still subject to congressional oversight and must work within the framework of the government's economic and financial policy objectives. So while they don't have to go to the President or get things ratified, they do have a set of parameters that they have to work within that's instituted by the Congress. So the Federal Reserve Bank has four main duties. They conduct the national monetary policy to ensure maximum employment, stable prices, and moderate long-term interest rates. So whenever you hear that the Federal Reserve Bank is going to lower the discount rate, what that means is that they're going to lower, because banks borrow money from the Federal Reserve Bank in order to lend to big companies, commercial companies, and consumers. So the Federal Reserve Bank will lower the discount rate, and that means that the banks, the interest rate for the banks is less, so therefore they pass that on to the consumers and the commercial companies, things like that. So that makes the economy, it enhances the economy and makes it start growing. So there's a balance they have to maintain. So they also supervise and regulate banking institutions to ensure safety of the U.S. banking and financial system and to protect consumers' credit rights. So they're the bank's boss. So usually once a year, twice a year, sometimes depending on the bank, then they send auditors out to make sure that the bank is going by the guidelines, that they're not discriminating when they're lending, they're not discriminating against anyone, they're making sure that all of the regulations are in place, that they're charging the right interest rates, all kinds of things that they come in and audit. And it was a scary time when the Fed came in and audited you, but that's something that you had to do. So they are all the bank's boss. The Federal Reserve Bank is over all the banks, and they make monetary policy, which affects the economy. So the Federal Reserve Bank has four main duties. They maintain financial system stability and containing systematic risk. They provide financial services to depository institutions, the U.S. government, and foreign official institutions. So when the bank takes in too much money, they ship it off to the Fed. When they need more money to operate, they order it from the Fed. So all the banks in our area would order from the Dallas Fed, and they would ship it because sometimes they can only keep so much money in their vault. That's a regulation. So when they have too much, then they ship it to the Federal Reserve Bank. So in 1933, Federal Deposit Insurance Corporation, which is FDIC, was created to protect deposits against bank failure. So we know that during the Great Depression, 1929, the stock market crashed. It was, it was really, really bad. And so people had a lot of people had their money in the bank. And so they had these runs on the bank where everybody was wanting to get their money out of the bank. Well, the bank didn't have enough money to pay them because, they've invested it and they've lent it out. So, they've lent it out to customers, so they didn't have it. So it caused the bank to fail. People lost money. So people didn't trust the banks anymore. Even today, there are people that grew up during the Great Depression that don't really trust banks as much as they used to. And so they, in 1933, they came out with the FDIC, which is an insurance that insures in case the bank were to fail again, then your money is insured up to a certain amount. It used to be $100,000 per depositor. It's now $250,000 per Social Security number. So even a lot of older people that grew up during the Great Depression, they may have $250,000 in one bank, and then to make sure that their money is FDIC insured, they take the additional over the $250 to another bank. So it says in the Great Depression over 10,000 banks failed, and this picture showing like a run on the bank. October 24th, 1929 is when the stock market crashes, and that kind of starts the Great Depression. So if you go into a bank now, it's a requirement that they have to have signs in several different places. They're little gold signs that says FDIC. So that's a big deal. If you go into a bank and you don't see that, then they're out of regulation. And they have to have them almost at every little teller station. FDIC. So in 1933, the U.S. currency was no longer equal to or exchangeable for gold. So Roosevelt, who was the president, issued an executive order requiring all gold coins, bullion, and certificates to be turned over to the Fed at $20.67 per ounce. Because people at this time were hoarding gold because, they thought it was going to be worth money. So hoarding gold in coin or bullion is punishable by a fine of up to $10,000 and or jail time. So he was serious. He was trying to get all the gold out of circulation. So he had this executive order that required people to turn it over, and he was giving them $20.67 per ounce. And if they didn't, they could go to jail. So in 1971, President Richard Nixon announced the U.S. would no longer convert dollars into gold. So the gold standard was completely replaced by fiat money. And fiat money is currency which a government has declared to be legal tender. That's all that means. But it's not backed by a physical commodity. So the dollar bill is just a dollar bill, and it's considered legal tender. But it's not backed by anything that is a commodity like gold. Gold is a commodity. And so before he said the gold standard was replaced by fiat money, then money was backed by gold. No longer. So fiat money just means that it's currency that's not backed by any kind of commodity. So today, technology has transformed the way Americans obtain financial services. So we have online banking, we use debit and credit cards, and ATM machines are commonplace. When I first heard about ATM machines, I just didn't believe it. That was a long time ago, but now People hardly can live without debit cards. New technologies such as mobile payment apps, smartphone credit card scanners, and digital deposit apps. Technology has changed banking a lot. I mean, even now you don't even have to go into the bank to make a deposit. You can do it you can do it with your phone. Okay, so we're going to stop there, and then we're going to get into monetary policy and how the Federal Reserve Bank makes that, the fiscal policy, and exchange rates.